Hi, I'm Martha Beaudry, Realtor with Boulevard Realty. Thank you for joining my homebuyer video series. Today we're going to talk about financing your house. In this video, I'm going to talk about the types of lenders, the types of loans, and some of the things you'll need to qualify. If you don't have time to watch this video, or you would like to not have to commit everything to memory, just send an email to the address below here, right there, and I will be more than happy to send you a cheat sheet so you'll have it for reference. Look forward to hearing from you, and let's get started. Okay, so financing your home. Even though you're a little early, I mean, maybe you're not really looking to get started for another couple of months, go ahead and reach out to a lender and get pre-approved. See what you qualify for. They can find out what you qualify for very quickly, usually within 24 hours. They don't have to do a hard hit on your credit. They'll have you go online or fill out an application, and then you can know just how much you qualify for. And the sooner you do that, the easier it is for you to be able to start planning your down payment and everything else you need to get started. So let's start talking first about the types of lenders that are out there. The first one are online lenders, and this is like Rocket Mortgage, Quicken Loans. These are popular. There are a lot of them out there. Online lenders are pretty aggressive in trying to get you to sign up with them. So that a lot of times they offer some really nice programs up front. The only thing you need to be aware of, at least this is the experience I've had when my buyers have used online lenders, is that the person that closed them and got them the loan was not the same person that processed it. Once you go into contract and you start to move forward with the lender, you get a different person, and they may not know what the first person promised you. So that's the only thing I find a little disconcerting. But the other thing that can sometimes be frustrating is that they're not usually in the same city, and they don't know what Houston nuances are. And I've had some appraisal issues and some other issues, but we got it to close, and we got through to the end. But they're okay. If you want to use an online lender, you'll be okay. Another one are big banks. Don't assume that if you're a client already of the bank that you're going to get special treatment. They do a ton of loans. It's not their primary source of income, and they don't expect repeat business. So if they can close on time, they will. You oftentimes won't be able to get a hold of your person during the weekend or in evenings. And sometimes those are the very times you need to ask questions. I can't tell you how many times I've shown a house on the weekend or in the evening, and my clients are like, oh my God, this is the house we want, but we need a new pre-approval letter and we want to submit our offer tonight. Believe it or not, there are lenders that can actually do that for you, but big banks have a tendency not to be able to do that. Local mortgage lenders, these are my favorite. These are most realtors prefer local mortgage lenders for several reasons. Number one, they have really good programs. They're local, they understand Houston, they understand how the city works. And because they pretty much rely on referrals from their clients and from realtors, they really work very hard to make it a great experience, to give you the best possible deal you can. A lot of them offer first-time home buyer programs. I can't say enough about local mortgage lenders. If you would like some references on some, just feel free to send me an email. I'd be more than happy to refer you to some great local lenders that have programs. And then your last one is the credit union. I mean, I really have to tell you, credit unions have come a long way. I've had a couple of deals that I've closed with buyers, and they were with credit unions. It was a great experience. And their lender actually was available to them on weekends and during the week evenings. So not all credit unions are the same, but I will tell you the two that I dealt with were very good. I was very impressed. So the type of loan, the first one is called a conventional loan. This is the most common. You'll be required to put 5, 10, 20% down. They even have some where you can put 3% down. And I have clients right now that are qualifying for 100% finance, and it's a conventional loan, and their private mortgage insurance is being waived. Private mortgage insurance is usually something you have to pay in addition if you do put less than 20% down on a loan. They usually have a tendency to require you to pay a private mortgage insurance, and that payment price is usually based on your credit. So the less you put down, the more your private mortgage insurance is going to be. But the good news is that, let's say you put 10% down on your house and you close, and 3 years goes by and now your house is worth more and there's 30% equity. You can ask for that private mortgage insurance to be dropped. So that's something you'll want to talk to your lender about private mortgage insurance and about how to get that dropped. All right. The next thing is government-backed loans. That's your FHA loan, your VA loan, and then that USDA RHS loans. Those are really for farmers. So FHA financing is good. They will finance for 3.5% down. There is private mortgage insurance involved in this. I don't know what the rule is now. There was a rule that if you got private mortgage, that you got an FHA loan, you could never drop your private mortgage insurance. That may have changed. If you're looking at FHA financing, ask your lender about that. Ask your lender what the rule is now on private mortgage insurance, and if you can drop that as you build equity. Otherwise, you would have to refinance, and that's how you would drop it. VA financing is awesome. If you are a veteran, I really encourage you to take advantage of that 100% financing. And then I know nothing about the other types of loans. I only do inner city real estate. I don't do anything out in the farm areas, so I don't know anything about the USDA or RHS financing, but it's there if you want to go buy a farm. There you go. Jumbo loans. These are loans for higher end properties. If your mortgage is in excess of $548,000, that's today. When this video is recorded, which is in October 2021, that's what's considered a jumbo loan. That number changes. So depending on when you see this video, that number could be less, it could be more. So you'll want to ask your lender if what you're borrowing is considered a jumbo loan. And they do sometimes have a tendency to have higher interest rates than conventional loans, although that hasn't been the case lately, but it just depends. But they have a little bit different interest rates and requirements than conventional financing. So what do you need to qualify? Well, to start with is your credit score. So you want at least 600. I mean, really the better rate is 650. The higher your rate, the better your interest rate. I mean, the higher your score, the better your interest rate. And the better your private mortgage insurance payment. So the best score is an 800 or above. If you have 650, that's fine. And then the next one up from there is over 700. But you can still qualify at 600, but 650 is more ideal. Savings, you'll want some money saved for your down payment. Let's say you're thinking about buying a $400,000 house and you want to put 20% down, then you need to have 80,000 saved. And then in addition to that, you'll need to have some money for closing costs. I have a video that strictly covers closing costs, and that'll give you a basic idea of how much you're looking to spend for closing costs. But just know you'll need to have money for a down payment and for closing costs. And your lender, again, can help you figure out what that needs to be. You'll need some job security. You need to be in your job for a while. You don't want to be moving around, switching jobs. However, if you have been in a job for a while, let's say as an engineer with Halliburton, and you've been doing it for a while, and then you switched over to Bechtel, it's not a big deal if you're staying within the same industry. If you're still an engineer in one firm and you've gone on to be an engineer at another firm and everything is consistent, then having changed jobs is not going to be a big deal. But if you decided you didn't want to be an engineer anymore, and then you switched over and became, you know, hotel manager, then they may want to see you in that job for a while before they'll qualify you for a loan. And you'll need at least 3 lines of credit. That could be a gas card, a bank card, a car loan, student loan, personal loan. They want to see 3 lines of credit. They want to see good payment history on those. If you only have 2 lines, just open up a line of credit. An easy one is a gas card, and even a personal loan. You know, let's say you just go to your bank, open up a personal loan, and just pay it off quickly. That's fine. So, and keep that credit line open. So that's what they want to see. They want to see 3 lines of credit. And then finally, they're going to look at your debt to income ratio. They want to see how much you're making and how much you owe. And the way, if you want to figure out how to determine that ratio, you just divide your total recurring monthly debt by your gross monthly income. And that will give you your percentage. And so they really want to see your percentage debt, 45% for a conventional loan. And if it's government-backed loan, they'll take 55%. So you want to try to keep that, you know, as low as possible. And, you know, if you do your calculations and you want a conventional loan and you find out your 60% debt to income ratio, start paying down that debt and get it down there to 45. Okay, so finally, you know, lately it's been trending that unmarried couples are buying houses together. So you'll probably want to have a conversation with your CPA about how you want to structure that. I have found that some couples have decided that one person was going to be on a loan, on a mortgage loan, and then after talking to a CPA, decided that they would both be on that mortgage loan. There are tax implications involved. Hey, you know, if you're going to be making mortgage payments every month, then you want to be building your credit. And mortgage payments have a huge impact on credit. And then you want to be on the homestead as well, because there are tax implications. So I would talk to a CPA about how you want to structure that. No shopping once you've been approved, especially opening up more credit. Don't go spend your money, and no mysterious deposits in your account either. Banks get real nervous when they start seeing changes in your financial status. And they will do another check on you before you close, or just before you close. They'll run a check and make sure that you have that you don't have more credit on your record, that you haven't spent lots of money, that you haven't, you know, made any weird deposits in your account. They do look at you one more time before you close. So you don't want to do anything to mess that up. Your loan will most likely be sold probably within 24 to 48 hours of closing. So you may close with XYZ mortgage company and then wake up the next day and find out Chase owns your loan. And then finally, ask your lender about interest rates, if they think they're going to go up or not, and when the best time would be to lock in your rate. You don't want to miss out on really good interest rates. But then again, you know, you may not want to lock in a rate because they're expecting them to go down. So that's just a conversation you want to have with your lender regarding when the best time is that you want to lock in an interest rate. And that's it. So remember, if you want all of this information in a single sheet, just send an email to that address right there, martha@marthabodery.com. I have other videos if you want to check those out on my homebuyer series, my video page. And thank you very much for checking in. And look, if you have any questions about financing, about anything about the home buying process, or if you want references for great lenders, pop me an email. I am never too busy for your questions. And I really appreciate you watching my video. So y'all have a nice day. Bye.